everyone, and welcome to our fifth webinar in our Generational Wealth Training webinar series. This will be our last webinar for the year, so we hope that you have found the series very informative and exciting, more interesting and exciting topics. Today's webinar is hosted by Ross McConaughey. He's been working at Robert Cowan Investments for 10 years. He is our global investments and investing expert at Robert Cowan Investments, and we're very certain that you will enjoy his webinar immensely. His contact details are at the end of the webinar, so if you have any questions or queries, please feel free to pop him a mail, and I'm sure he will get back to you shortly. And with no further ado, I'd like to introduce you to Ross. Over to you, Ross.
Great. Thank you very much, Kate. It's my pleasure to present today to all of you, and I hope you find all these slides useful and entertaining. So this is, of course, our fifth webinar in the series and our final webinar. And I'm going to chat to you today about the global investing, the merits of global investing as a South African, what are the advantages and disadvantages, and what are the current themes and trends in the offshore markets right now, especially what's going on in inflation and valuations in the world, America, China, a little bit of green investing and what's happening in that theme at the moment. And we'll delve into two of our favorite companies that we like in our portfolios. So let's get on to the presentation. I'm just going to switch off my video just to make it full screen for you all. But if you have any questions, please feel free to ask them in the question box, and maybe we'll get through to them at the end of the presentation. Thank you. Okay, so why would you want to invest offshore? I always have this analogy: if you were a Martian and you wanted to invest in the world, why on earth would you invest in a small country on the southern tip of Africa that's only 1.5% of the global GDP? Of course, there's such a wide, big world out there that's full of diversification and opportunities. And of course, South Africa is highly driven by resources. It's really a quarry to the east, and is hugely related to the fluctuations and cycles of the resource-driven economy. So you really want to try and diversify away from that kind of risk. And you've got opportunities in the tens of thousands of shares around the world. So we tend to look at developed markets mostly, just to diversify away from our emerging market risk, as I said. But there are also emerging markets that are far better than South Africa. You know, you're looking at the GDP tailwinds in India and China, and just demographics are so supportive of equities. So even though you would want to have some emerging market exposure, perhaps it shouldn't be at all in South Africa. And we as a house, we prefer companies that have got very high return on capital employed. For example, America has literally hundreds of businesses that have got a high ROCE, whereas South Africa, we only have a handful. When you're going offshore, you also get opportunities to invest in different themes like growth and value. Of course, we have that here in South Africa, but the extent of which in overseas is just magnificent. We aren't cigar-butt investors at RCI, but there are those kind of opportunities for that deep value investing in oil pipes and sort of drilling and things like that are out of favor at the moment. That's not something we delve in, but those are the kind of opportunities that you can get that you can't get in South Africa. You also get exposure to nice thematic ideas like green energy investing, ESG, biotechnology, genomics, all those kind of flavors of the month. So those are the kind of things you just don't get in South Africa, especially when you look at technology and those kind of opportunities that South Africa just can't really perform on a global basis. Okay, so let's take a look at the first real advantage as a South African. So this is a graph of the MSCI World Developed Markets Index. It's an index of all the biggest countries in the world and the biggest companies in the world. And they're all from the developed markets, of course. And this is a graph for the last 25 years. It is the price of the index moving up and down on a monthly basis. And these major pullbacks here are the big financial events that we've experienced the last 25 years. So this first one is the dot-com bubble, where the market fell 48% and then rose again. And then we got the terrible GFC, which then fell 56%. Now, this is all in dollars, I may remind you. We had a 12% correction in the 2015 era. And here is this quick blip on the radar here of the COVID-19 20% pullback, and then shoot out from there like a rocket. Now, let's take a look at the Rand on the lower chart here. This is the Rand dollar during those same periods. So during the dot-com bubble, the Rand blew out from 6 Rand to the dollar all the way through to 12, settled at a 10 before the market started to improve again. And during the GFC, we had a big strength in the, big weakness in the Rand dollar from 7 odd to $10, and then it strengthened again. And here during this period here, we had actually a massive rise in the Rand, which was also aggravated by the Nene Gate at the time. And here during the COVID-19 pandemic, you could see the Rand blew out from 14 Rand to 18. So the Rand tends to move in the opposite directions of the market every time the Americans panic. That's because they pull their money from the emerging markets, and all that liquidity goes back to America, and the demand for dollars increases, and the demand for emerging market currencies like Rand falls, and you get a massive weakening in the Rand. So why is that great? Well, if you look at this same relationship on the top now in Rands, look at your fall now. You've only fallen 23% during the dot-com bubble. You fell 29% during the GFC. And in 2015, you actually rose in Rands. You were richer in Rands through this period because of the Rand weakness. And here during the COVID-19 pandemic panic, you were actually richer in Rands. So let's put this into a table. And this is the S&P 500 now. This is the American market. So these are the drawdowns. These are the plus 10% and about worse sort of pull downs in the last 25 years. And the worst, obviously, as I said, was the GFC, 56% pullback in USD terms. Now, the average of this is a 26% fall. So on average, you would have lost a quarter of your money in any one of these events, with the major two being in the beginning and the end here. And what happened in Rands? Look at this, only 23%, 29%, 2% positive. As I said, some of these are positive in the period. And here you've literally had a drawdown average of 13%. So as a South African investor, you were so well protected by the Rands that it looks on your statement at the end of the month, you've only would have ever lost 13% at the worst possible period on average. So of course, it's important to look at your performance in dollars, because the underlying investments are dollars, but it's also really important to look at it in Rands, because that's where most of your costs are. So as a South African investor, you really actually had a very smooth ride compared to an American investor of losing all that money in dollar terms. So let's take a look at the market at the moment. This is a really interesting graph. This is the quarterly EPS of the American index called the S&P 500. It showcases all the major recessionary events and how many years it took for the recession to recover in earnings per share. So this is the aggregate earnings per share of all the 500 businesses on the market. So it took 3 years in the early 90s to recover from this recession. But here's that dot-com bubble again, 3 years again to recover. And here's the GFC. That took a whopping 4 years. So that was a terrible time for the world. As you're all aware, it was recent memory. But take a look at this anomaly here, the COVID-19 pandemic era. You had literally a 1 year recovery to the previous high in EPS. We haven't seen anything like that before in history. And why is that? Well, it's because the Americans stimulated their economy like never before. This is a graph of the money supply in the American market, and the American economy, should I say. And typically speaking, it increases slowly, and the Fed controls it quite nicely over time with the growth in GDP and the growth in demand for money in general. But here you can see during the COVID pandemic, they literally plowed trillions of dollars into their economy. And it literally caused a whopping inflow of funds into a country which is obviously going through a massive tumultuous time during the COVID pandemic lows with the lockdowns that we obviously experienced too. So you had all these assets, all this money coming into the economy, chasing fewer assets. And what actually happened here? What does that actually cause? That actually causes an inflationary event, which is what the biggest talk around the town is at the moment in the market. So let's take a look at what inflations look like over the last few quarters. Let's start on the left-hand side. So CPI, as you know, is the inflationary figure of a basket of goods. Core CPI, this darker sort of browny color, is the inflation when you exclude energy and food prices. So if you're taking a look here, what happened in the COVID-19 pandemic, it fell off a cliff. This is a month-on-month change. So it fell off a cliff, quite frankly, and it bounced back quite nicely straight after that, the deepest, darkest part of the pandemic era, in the March era, in the worst lockdowns around the world. And you had to bounce back up there. But what we see now of late is a big jump up in inflation. And a lot of it's caused by various issues with regards to supply chains and labor, and also transport of goods and the raw materials that are coming through. And that's actually started to cause a lot of inflationary impact into the market here on both the core and the CPI inflation. If you look at this graph on the right, this is now the same core, but now split out into goods and services. So this is the pandemic era. And here, if you're looking, let's look at goods only at the moment, the dark color. Look at how goods shot up. That's because during the stimulus, the checks that all the Americans got, they started spending their money on new goods. They spent it on cars and new cell phones, new computers, new iPads, all sorts of goods that they could expense on that they couldn't do so in services. And generally speaking, America is a service-driven economy. Services include everything from restaurants to tourism, to any sort of labor sources and any kind of non-goods related activities. And that's came back with a flash from the stimulus, but the money hasn't gone into the services industry. So you see now it's still sitting down the services, and we still haven't seen this jump back up in terms of tourism and things. But with this pandemic sort of settling now with the amount of people vaccinated, we do expect this to come up a bit more in the next year. So goods has come through sharply, and that's what sort of panicked the market. But let's take a look at this graph now on an annualized basis. So this is now year-on-year percentages. So if you think about us in South Africa, we tend to think of inflation as a 4 to 5% event. We're used to it. That's part of our way of life, and we expect that kind of inflationary increases on our salaries and wages. So for Americans, that's usually about 2%. And here's the drop off here from the pandemic. And here's the year-on-year change. It's spiked up here. Now, this is what made everybody panic. And expecting, sure, is this going to stay up there forever now? Are we going to have a 4% raise in goods and services and wages and everything up every year? Well, realistically, no, that's not going to happen. They're going to find a new transition into the next 2 years or so, where the labor is going to have to find the right percentage increase in salaries and wages to entice people to come back to work. I'm sure you've seen a lot of talk in headlines about the labor shortages and things like in logistics and trucking. I mean, they're really struggling to get millennials to come and do the trucking because they'd rather stay at home in their parents' basements. Week at a time. So at the moment, they're trying to, this new equilibrium, and they're going to have to entice more people to come back into the market. And so it's causing a bit of an inflationary increase on event. But remember, inflation is a change from one year to the next. It's not a year-on-year amount, but just because it's gone up now from a low base doesn't mean we expect it to go up another 5% every year. So it should come back down with sort of new sort of balance between supply and demand coming forward. this is a really interesting graph. It is it's a measure of the number of times the word supply chain issues has been mentioned by management over the last several years. And you can see, of course, there's been this massive spike up over the last 2 years. And of course, that was all triggered by the COVID-19 pandemic. As I said, there's been a shortage of drivers, but there's also been things like shortage of microchips and all those kind of things that people sort of need in their day-to-day life. Supply has sort of lagged the demand, and we've got a bit of a deficit at the moment that is trying to find its way through the market. But reading the headlines now with this new foundries being switched on in the semiconductor space in Malaysia, that should come through to the motor vehicle industry quite soon. So these sort of things tend to figure themselves out. And it's obviously a very unique circumstance, a COVID-19 pandemic, because also a lot of the factories that were supposed to be built and all that sort of capital and expenditure never took place in the pandemic. So the world's doing a bit of a catch-up at the moment, and we should see a bit of a recovery from here. So how does one protect an economy from inflation? So I'm sure many of you have heard about rising interest rates in America. So what the Fed can do to sort of stop an overheating economy is raise their interest rates. I mean, we always see that in our country when you hear about the government raising prime, and they can do the same thing in America. The rates are very low at the moment at 1.5%. But if the stock market and all the asset prices are just too high, and literally the markets start overheating too much in terms of inflation, the Fed should step in, or they probably will step in and raise interest rates to bring back down the sort of the stimulus of the economy. But they would be very reluctant to do so at the moment because unemployment is still nowhere near where it was before the pandemic. So take a look here. These gray bars are the periods of recession. So here again is the dot-com crash, a recession. You can see unemployment rose up here. Then the market and the economy came back, and here's the GFC, and you had a massive increase of unemployment to 10%. And we've had this glorious period now, just till pre-pandemic, where unemployment was sitting below 4% in the USA. Absolutely fantastic levels. You haven't seen that kind of levels in decades. So look at the spike in unemployment now, because obviously people were forced to go home. It was an unnatural recessionary event in a way that caused all this people to come back. And as I mentioned earlier, they still haven't got it right yet. There's certain parts of the sectors that are looking for laborers, some parts that are full because people migrated out of their sectors to other sectors. Why would you want to go back to the hospitality sector and tourism when people are coughing on you and in a pandemic? So, they went and seek unemployment elsewhere. But there's also a lot of the services sector hasn't come back. The restaurants that are closed and permanently closed, and the hotels are permanently closed. So again, this is going to take a few years before it gets back to where it was in pre-pandemic levels. So it will be unlikely that the Americans will raise interest rates in the next few quarters until these figures come down. But they obviously will balance that with the inflation. So what has this all led to? So at the moment, assets are very expensive. I am sure you've seen the headlines about housing prices, all-time highs, things like cryptocurrencies, all-time highs, and the stock market, all-time highs, in alternative investments like collectors' cars, collectible items, all these things are just so much more expensive than they were pre-pandemic, because again, was all that stimulus has come into these assets and raised asset prices. So this graph here is the price of the S&P 500 equity index, and it has risen. So again, I'll go back to here's the dot-com crash, here's the GFC, and here this little blip over here is the pandemic crash. And we've flown all the way through it like a rocket ship to all-time highs and teetering on all-time highs. And the orange level here is the price-earnings ratio. So it's a simple metric of taking the price of the stock market, dividing it by all the earnings, and it's a multiple. And it really kind of gives a scale about when the stock market is expensive, say over 17 times, and when it's cheap, like under sort of average is 17. When it's more expensive, over 20, and under 15, it's cheap. And at the moment, it's 25 times. You have not seen this kind of valuation since the dot-com era. So that makes us as investors on the global basis very reluctant to deploy a lot of money into the American market. So we, of course, are always exploring alternatives in the likes of Europe and Australia and New Zealand, but they've got demographic issues, and a lot of those economies are driven by financials and insurers that are very, aren't high return on capital businesses. They're not good businesses that we tend to look for. So the alternative is still we're looking in Asia. And China, of course, the second largest economy, soon to be the largest. It is still the major player in the world right now. But what's gone on lately is huge regulatory intervention, huge crackdowns on certain sectors in their economies. And that began with the likes of Alibaba and Jack Ma, where they blocked the IPO of the Ant Financial listing. So China's got a big focus at the moment of the 5-year plan, and anything that can have an impact on their society, they would like to regulate. So there's an interesting quote here that speaks true to what goes on in the world at the moment. USA innovates but doesn't regulate, when we see that with the problems with Alphabet and Facebook of late. Europe regulates but doesn't innovate. Again, they muddle along. And China innovates and they regulate. Maybe they regulate too harshly. So let's take a look and see what has actually happened here in the Chinese space. So there's been 3 major pillars that the Chinese government has targeted. The first has been the antitrust probe, and that's really targeted Alibaba, Tencent, Meituan, and they've really been scrutinizing the way they do business, the way they disclose their mergers, the exclusive contracts, and sort of blocking each other on their platforms, all sort of scrupulous business activity that that really does need to be addressed. Misleading marketing. There's no real sort of definition to all these things. So it's really, they really need to crack down on that kind of stuff that we already see in the Western world. The second part they're trying to target is data security. And we saw that with Didi. They really have scrutinized Didi's with the most recent listing. I don't know if you know what Didi is, but it's the Chinese version of Uber. We've heard a lot of advertising on 94.7 and things like that about it. And it's part of their plan to make sure that the Chinese the Chinese data is secure for the future. And then the other section is anything that's to do with public interest. And we've seen Tencent take a hit here because of the gaming controls for minors and the amount of hours that they can play on their systems. And we've seen Ant Financial, which controls all the financial transactions, a lot of the behind the scenes, and the controlling the fees and prices. And the biggest hit we saw this year was the push, or should I say, the regulation of changing all the tutoring services from a for-profit to a non-profit. And that effectively destroyed their businesses overnight. So that really has scared the market. And we'll take a look here and see that the American listed ETF of the Chinese businesses that are listed on the American stock market has collapsed 45% to its low. So these are all to its low. We've seen massive falls, even in the biggest companies like Tencent, Alibaba, and Baidu, J.com, even all the way through, as I said, about the online tutoring, they've taken a massive knock to 90% plus down from their highs to their low. So there's been significant moves in China, but we don't want to. We're keeping an eye on their risk, and we don't want to disregard them as an economy, because they are going to be the most powerful nation in the world, and they do have a big impact on our global economic portfolio. So we are measuring all these things carefully all the time. So another thing to talk about is ESG and green investing. That's obviously a very topical trend at the moment. So what we've gone and done here is put down the iShares Global Green Energy ETF, which actually listed in the middle of the GFC. I didn't pick this period. This is the first date. that it started, which is ironic because they tend to list these fancy products in the best of times, just before crashes. So it's always a red flag when you see all these different fancy ETFs come online, because it means it might be the top of the market. And what I want to show here is, if you were the first investor on the first day and you put $100, and literally now 13 years later, you'd still be down $50, 50% of your money. Whereas if you invested just in the World Developed Markets Index through the period, your $100 would be $225. So it shows you the significant underperformance that the green energy investing has played. And now, why is that, Why is that? Well, part of the reason is that the green energy businesses, they rely a lot on government grants and benefits. And there's also deflationary in nature. Think about something like solar panels. Over the last 10 years, the cost of solar panels has dropped considerably over the years. So if you're competing in that space and you're manufacturing them, and your neighboring competing manufacturer is making it cheaper, then you're going to bring it cheaper, and then they're going to cheaper, and that's a deflationary, and nobody's making better profits. And it's really just destructive for your sort of business, especially if you don't have a moat. If it's not high technology and it can be easily replicated, like a solar panel and a wind turbine, it's not incredibly difficult technology. It can be replicated for cheaper in China. So that is a deflationary problem, not good for profits. As you can see, it's not good for business in terms of investing. So as ethical as you'd like to invest in those kind of businesses, it doesn't always translate to good share price return. So this is an interesting graph. This is the demand for energy in various forms based to the 2019 levels. So let's go through this one. So renewables, which is the trend at the moment, as we're all well aware of, in 2030 is expected to be 60% more demand for energy from renewables than the 2019 level. So that's how you read this graph. Gas is 1.1 times, and you've got nuclear still rising, oil still rising. So you think, wow, even though with all the advent of EVs and things, oil is still increasing because it's still an important integral part of the global economy. Now, what's interesting is coal hasn't fallen off a cliff to correspond with the renewables going up. And there's a main reason for that, because coal is an integral part of the global economy's grid. And I'll show you on the next graph why. Because if you take a look at the current base load capacity of energy production in the world, 150 gigawatt hours, in terms of splits up between coal and natural gas, you can see most of it's dirty power at the moment. In order to replicate this amount of energy, you would have to, in a renewables, so solar and wind, you would have to put out and expand 3 times the amount of solar, wind, and storage than the current gigawatts that are used by dirty production. Now, why is that? Because, of course, solar is only really effective 6 hours a day, and the wind doesn't blow all the time, and we still don't have a good way of storing all this energy for the peak periods of the day. So as much as we want to move towards a green economy in the world, it's very, very difficult to do so, especially without having nuclear on board. It's just not feasible and realistically not possible to replace all of coal with green energy at this point in time. And so that's what I said in that previous slide. Coal is still going to be around. It's not going to be a fall off a cliff. It's just too much demand for energy. Remember, the world energy demand is rising every year. So yes, most of it may be going towards solar and wind, but there's still a deficit, and they have to keep building coal-fired power stations. So that's just a very interesting graph that just to show you that the dirty power has still got a place to play in this world, especially during the peak periods like of the mornings and evenings when power is used the most and people are at home. So how do we invest at RCI? We typically are looking for companies that are international branding. They are large market cap stocks, primarily listed on developed market stock exchange. And we avoid cyclicals. We prefer companies that and have annuity-based revenue streams. And we consider growth a tool in the investment process. It's not, we don't look at growth versus value. As I said earlier, we're not value investors looking for cigar butt businesses or beaten down businesses like oil, energy and things like that. Or we like high quality businesses with strong balance sheets that have a high return on capital employed, that are compounding every year. And we like these businesses to take advantage of growth in the emerging markets and the growing middle class around the world. And of course, taking advantage of aging population. So that's the kind of businesses that we tend to favor. So let's take a look at two of our favorites. The first one is Adobe. Adobe is one of the world leaders in the creativity and design. It's a software as a service business. It's specialized in digital automation. It's really in the space of cloud computing, modern productivity, and AI machine learning. And the business is split up into three major pillars. Most of you may know Adobe for like Acrobat and Photoshop. There's Lightroom and Illustrator. That's all in the creativity side of the business. And that's a software as a service business. And they recently actually got Netflix as a customer, and like the video editing and that kind of thing is all done with their sort of software. So all digital kind of editing and things like that. The next major part of their business is document productivity. And that is accelerating paper-based documents into the cloud so that they're accessible around the world for employees that are working from home. And that's had a huge bump up now during COVID. And then the third part of their business is the digital transformation of companies onto the online space. So they really are like a consulting firm that transition a business that doesn't really have good exposure to the e-commerce side of the world, as well as online advertising. They are able to do the data analytics and really support them on that journey. So it really covers really nice, three great growing segments. Taking a look at their margins. So they're very dim here, but the margin is the gross profit margin has gone up from 86% to 88%, which is great, a little bit improvement. But the real improvement's been in the operating margins, going from 28% through to 37%. Now, this major bump here in the last few years comes from the COVID pandemic, and there's been a huge increase in businesses spending money on their digital footprint. And that's obviously come through to the bottom line of a company like Adobe. And they've had less expenses. I mean, all the employees are working from home, less travel across the world. All those kind of cost cutting has been hugely advantageous to their business. And let's take a look at their return on capital employed. Their high ROCE business has gone up from 15% to 23% last year. I mean, that's fantastic. That's the kind of thing you want to see. That's hugely compounding. I mean, your business is growing massively every year. And that's because of that, you're going to pay up a bit. I mean, you're going to pay a 45 times multiple at the moment for this business, but these quality businesses don't come cheap. So just in conclusion, it's a software as a service business. 90% of it is revenue that's annuity based. It's fast growing, high quality earnings, low debt levels, hugely innovative business, an expanding global customer base, and growing return on capital employed. All these fantastic metrics are great for long-term compound growth. And another favorite of ours is the Stryker Corp that's in most of our client portfolios. Stryker is a medical device manufacturer that specializes in orthopedic equipment. They specialize in three different segments. The first is surgical equipment and anything that's used in the operating theater, and as well as robotics and orthopedics devices like hip replacements, knees and shoulders and things like that. And then they also have a neurological and spine segment where they operate in terms of damaged spine and when you have slip discs and things like that needs to be replaced and that kind of stuff. What's really fantastic about Stryker is they also are at the forefront of robotic surgery. And this is really the big move in technology in the world at the moment. It's really accelerating this symbiotic relationship between a robot and a surgeon. So a surgeon can perform the surgery from the room next door whilst the robot is doing the incisions and the cutting. And the advantage here is very specific and very precise cuts in the bone. And that allows for a far better and more precise implementation of, say, a knee replacement, like what's going on here, and a better recovery time and better sophistication in many ways. So they've got a bit of they've got old school technology as well as new world technology and transitioning to the future. And that's the kind of thing that we really like in this kind of business. Just looking at the PE ratio again, it's a bit expensive, but that's partly because the earnings have been a bit depressed of late because a company like Stryker was dealing mostly in what they would consider elective surgeries and not emergency surgeries. So a lot of that was put on hold during the pandemic. People had to wait to now another year for their hip replacements and things. And that's all coming through now. And earnings, which had a nice big jump in earnings for this financial year. And we should see the valuation come down nicely as earnings comes up. So just to conclude, why I like this business, it's really a perfect position to take advantage of an aging developed world population, as you can see on the graph on the right. In the next 50 years, there's going to be a huge demand for these kind of procedures. And I'm sure many of you know other people who've had all these hip replacements and had really good results. It's become very common. And this business also takes advantage of a growing emerging market middle class who's getting wealthier to afford medical aid and this kind of healthcare expenditure. It's also really great, this business, as opposed to a pharmaceutical. It's a very sticky business because once a doctor is familiar with the apparatus that they're using and putting into people's bodies, they're very reluctant to switch to another brand for cheaper, etc. So it's very sticky with doctors. It's also very, it's price insensitive, because patients are very sensitive to things like medication expensive. When they go to get their drug pricing at month end and they see how it has risen by the pharmaceutical giant who's risen their price, they get very angry. But here, you don't see the cost of these devices. It's all wrapped up in your surgery that your medical insurance pays for. So that makes it nice and tied up there. And as I said earlier, it's also not as exposed to patent cliffs like pharmaceuticals are, and also won't be targeted to the same extent as pharmaceuticals get when by the Democrats every sort of 4 years in their elective procedures. So all in all, fantastic company, good parts of the business. We continue looking for great ideas in the offshore space. We have been investing in a whole new bunch of ideas, and they're starting to appear in the offshore portfolios. And if there's anybody who'd like to chat to me about offshore stocks or any questions, I'm always free to chat. You can call me anytime or drop me an email. I'm always interested in talking about shares, really passionate about it. So thank you very much for your time today. I hope you found the slides interesting and beneficial. Great, thank you very much, and have a great day further.